Good morning, everyone. It is a feeling more early than it is. It is 9:30, so we are not providing you with breakfast. We're going to be providing, I should be a little less informal. Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, president of the Institute. This is, in a sense, the start of our very full and hectic series of events that will be coming up around and through the annual meetings of the IMF and the World Bank. All of our public events, on-the-record events, will be webcast live, and we hope that our friends out there, as well as our friends present in the audience today, will be watching and benefiting from those events. Today, I am very happy to kick things off with the launch, or at least the external launch, of the IMF's 2013 External Sector Report. We call it the pilot report, or they call it the pilot report, because it is a new product. And it's a product that we at the Institute, that our colleague Joe Gagnon in particular, but all of us, including people who worked in the tradition of John Williamson and others, have a great deal of regard for the intent. It is an attempt to look at the evolution of external sector positions throughout the IMF's membership, in particular of the key countries, the world's 28 largest economies, plus the euro area. Think about exchange rates, capital accounts, current accounts, reserves. Reserves obviously being the politically sensitive piece of it in some ways. And trying to distinguish what's going on for structural reasons, not just cyclical, and most importantly, where policy measures taken in some of the large economies spill over onto and have effects and impact on other economies. And as part of the IMF's effort, both at surveillance, I can never say that right now that I've lived in England, surveillance, and at transparency, we actively support that the fund is doing this. That said, it doesn't mean we agree with either all of their, I shouldn't say we, it doesn't mean everybody agrees with all of their methods and all of their conclusions. And PIIE Senior Fellow Joe Gagnon will be presenting his constructive comments on the report after the presentation. Just to note, we have three distinguished members of the fund's staff here today to present. Speaking first will be David Robinson, who headed the External Sector Coordinating Group that produced this. He's a deputy director of the IMF African Department. He's had many different assignments at the fund. Many of us got to know him when he was running the WIO and the research department. He's headed IMF teams in Saudi Arabia, Tanzania, and the Caribbean, and the former Soviet Union. He's taught at a number of universities in the UK, so he knows how to pronounce surveillance. He'll be followed by Steve Phillips, who's with the IMF's research department. He's chief of the Open Economy Macroeconomics Division. He's leading the team that is developing the external balance assessment methodology, which, without wanting to presume too much, I think is what underlies this report. And he's previously worked in the Western Hemisphere department, working on the Mexico team, and a lot of work also in the former Soviet Union and Latin America. And then joining us on the final panel with some expertise in some of the more technical matters is Alison Stewart, also from the fund, who's currently the Deputy Division Chief on Australia, Asia, and Pacific Department, and previously was Deputy Division Chief in Surveillance Policy. Just to give you an idea of the quick format, the fund is going to make available the report. It's obviously going to be available for download from the website if it's not already. We will link to it directly from our website, so it'll be easy for you to get it. And I believe we'll also have copies of the PowerPoint presentations and Joe's presentation on our website. We're going to ask David and Steve to present the report. Then Joe is going to stand here and give his response to the report. This isn't a rebuttal. This is a constructive critique, what he likes and what he doesn't like. Then I'm going to call the group up to the panel, and Allison will respond to Joe, and then we'll open it up for discussion. I see a number of faces well known to us and very expert in the audience, and so we're looking forward to the group discussion as well. But first, if David is willing to come up to the podium and take us through the initial parts of the report. Thank you very much.
Thank you, and let me say up front how much we appreciate the Peterson Institute hosting this again, as you did a similar event for us last year. As you know, the focus of today's event is the 2013 Pilot External Sector Report. The key component of this report is it contains the fund's assessment of the external positions of the largest economies in the world. And it's designed to try to integrate the analysis we do at both the multilateral level through our products like the World Economic Outlook and the GFSR and those kind of things, but also bring in what we know from the bilateral surveillance, Article 4 consultations with the individual countries. Now you'll notice in the title we still use the word pilot. That is because this is a new product. And this is the second year that we have produced this report. And it's very important for us to continue to get feedback on how we can make this into a better and more useful product. Through the analytical tools, the coverage of issues. And certainly, as was said by the chair, the report is available on the website. In addition to the main report, there is a separate report on individual country assessments. All the models that we are presenting today, the data and actually the results, are also posted already up on the website, and we very much encourage people to use those. So let me begin, and then Steve will come back on the methodology, and I will come back towards the end. Now, in terms of the basic structure of the report, now we have tried to keep some of the key cornerstones from last year. I mean, the basic purpose is the stock taking of to produce a multilaterally consistent assessment of the external sector policies of the largest economies. We cover actually 28 economies plus the euro area. This feeds in and is therefore consistent with what we do in the individual country, the Article 4 consultations. And we pull on the analysis from a wide variety of tools we have developed, some developed within the fund, some from outside. In particular, this new method, the external balance assessment, which Steve will talk about later. The assessments cover a broad area of the external sector. This is both the current accounts, it's the real exchange rate, reserve positions, capital account, both levels and policies, and also the broader external asset and liability positions. Now, in terms of what is new for 2013, I think this year what we have tried to do is give additional context to the assessments by giving a really broad overview of fairly significant developments during the last year. In particular, issues that were there were capital flows, both the levels and the volatility, in particular how they affect emerging markets, and also some discussion on trade policy. And reflecting the feedback we received last year, there are some new refinements to the methodology on the EBA. And also, as I had mentioned, we have published this year the individual country assessments, so that there is a single page providing a summary of how we see each of those 28 economies plus the euro area. Starting with a look at the basic data, the global current account divergences. And I'll try to be specific on the terminology we use, and I'll try to stay consistent. By divergence, we mean just the headline number, surplus or deficit. This may be appropriate, it may not be appropriate. This is just the headline numbers. And what we have seen over the past year was that there was a slight narrowing in 2012 relative to 2011. But really the key thing is that they are very substantially lower than based in 2006, 2007, when the great debate on the imbalances started to come through. In terms of what we saw in 2012, I mean, we saw in some of the surplus countries and the euro area deficit countries, we saw a narrowing. As oil prices started to fall towards the second part of 2012, and also reflecting in some cases higher fiscal spending, we've seen the surplus of the oil exporting countries come down. The euro area obviously is an aggregate, and so we've split it here into deficit and surplus countries. And what we have seen is that the surplus countries, we actually saw an increase in the surpluses, particularly Germany, while in the deficit areas, parts of the euro area, we saw those surpluses come down a little, particularly in the crisis-affected countries, where there was quite a sharp fall in some cases in the import levels. Taking a fairly long view at this, where we are in 2012 relative to the peak in 2006, 2007, we can see that all regions of the world have contributed to this reduction in the divergences. The largest contributions, both in terms of absolute size, but also relative to GDP, have actually come from the largest economies, China, Japan, and the US. Now, obviously, one of the immediate questions is this reduction that we're seeing, is this just cyclical effects? Is this the impact of just the slowdown in the global economy, or is there something more underlying it? So to take a first stab at this, just take Steve and his team run through and extract the cyclical component. So we get the cyclically adjusted current account balances. And here by cycle, we are trying to take out both the output gaps, but also the commodity price cycle. Key components here is that what we have seen is that the blue bar is for 2011, the pink bar is for 2012. We've seen several countries have seen a narrowing, but certainly also on the deficit countries, we've seen a number of countries there that did see a widening in their cyclically adjusted deficits. Particularly we saw India, Indonesia, I guess South Africa, and a couple of other countries. But there has been some countries also that have seen the narrowing. Now, the other side of this, I mean, again, just basic data. Looking at the flip side of the current account, and when we also put in the capital account and therefore the reserve accumulation, and obviously the three of them have to add up, what we have seen with the narrowing of the current accounts is also, in many cases, a smaller capital flow contribution, and that has also contributed into lower reserve accumulation in 2012. Certainly, if we look at, say, a country like China, we actually saw capital flows actually reversed in 2012. There was actually a small outflow, and the reserve accumulation has come to a very small number. Also, the emerging Asia countries, again, traditionally surplus countries, have seen that accumulation come down. One part of the world where we have seen reserve accumulation go up was actually the other advanced economies, and we'll come to that in a minute or two. Now, in terms of the capital flows component, I mean, one of the concerns throughout the last couple of years has been not just the level of capital flows to emerging markets, but also their volatility. And here we did a very simple breakout, and this is just through the end of 2012. I mean, obviously there's been a lot of turbulence in the last couple of months. What you see is the blue bar is the essentially the FDI, foreign direct investment component. And therefore, most regions, you see a fair amount of stability there. But where you do see the volatility are more the portfolio flows, and particularly you do see them switching between inflows and outflows from time to time. Now, obviously we talk about volatility a lot, and it's often thought of as being a bad thing, but we do have to step back a little and remember that the capital flows, the inflows, have brought opportunities, and there have been benefits from them, but they also have created some vulnerabilities, right? So it really is a case of how we weigh those two. Certainly, a couple of things we have seen is that you have seen greater corporate leverage and foreign currency exposure build up in some of the emerging markets. And we've also seen a significant increase in the foreign ownership of sovereign emerging market bonds. Now, obviously, these flows don't happen in a vacuum. There are policy responses. And so what we tried to look at here was in terms of the volatility of the flows, what are we seeing in terms of the actual outcomes, both by looking at the exchange rate and the capital flows. And here we use the coefficient of variation, which is just the mean divided by the standard deviation to give you a unit 3 measure. And certainly what we have seen is that the capital flow volatility has been very high in the financial centers, as you would expect, the Switzerland, the UK, Singapore. But the exchange rate component, the exchange rate fluctuations, have really been focused on the emerging markets. Here, Turkey, India, Brazil, South Africa, where, given the size of the flows and the policy tools available, there has been some use of exchange rate to let the adjustment take place. But as we have seen over the last couple of years, both the advanced and emerging market countries have used quite a range of policies to try to manage the risks. In some cases, like Switzerland, there was a quite unusual tool. They introduced a floor on the exchange rate. Denmark introduced a negative interest rates on deposits to try to deter flows. And also countries like Brazil at times have imposed and then withdrawn capital flows to try to adjust the flows coming in and out. In terms of the picture on reserve accumulation, obviously one of the more sensitive components, when we look at the pattern over the last year or so, what we have seen is that the reserve accumulation in Asia has slowed very dramatically. Remember that earlier picture. But where the other countries that are seeing the accumulation, the other advanced markets, a lot of this is the oil exporters, Saudi Arabia. But then Switzerland, from this, we had seen, there was very substantial safe haven inflows had come in, which had pushed up the exchange rate very rapidly. And the authorities had responded by introducing this floor on the exchange rate. So they ended up purchasing quite a substantial amount of foreign exchange reserves in order to protect the exchange rate. Now, as we move from the description to the analysis, I should turn to Steve for.
Does this work? Just oh, okay. Thanks, David. What I'd like to move on now to is the assessment of current accounts and exchange rates. So this is the part that sometimes is controversial or sometimes sounds like the bottom line. Everyone wants to know, is somebody overvalued or undervalued? Well, I think we can approach it with a little less drama than that, but if that's what you're waiting for, this is the part where we get to it. But first, a methodological word. I think before talking about exchange rates or current accounts being too strong or too weak, it's very useful to clarify up front, what standard are we judging them by? And it's not an obvious question. So let me explain to you what it is that we're trying to do in our assessments of current accounts and exchange rates, both in the ESR and in the David's talking about and our team's EBA method that's in support of that. What we're trying to do is compare current accounts and exchange rates to an appropriate level. And what we mean by an appropriate level, it's a normative analysis, right off, you know that. It means relative to what would be implied by country fundamental characteristics. So things we'll get into, but demography, rich versus poor, things like that. This is one that's often overlooked. It's the appropriate level also has to be consistent with natural temporary influences on the current account and real exchange rate. Current accounts and real exchange rates move around, and not all of those fluctuations are problems. So we need to take account of what are the appropriate responses to temporary factors. And finally, we need to face the reality that in this world, current accounts and exchange rates are influenced sometimes by policies, sometimes policies that are maintained for many years. So once we admit that, we have to think about, well, are those policies correct? Are they desirable? So our current account and our real exchange rate norms are going to be based on our ideas of whether certain policies that are relevant for current accounts and exchange rate determination are at appropriate levels. Maybe that seems natural or obvious. What else would we be looking at? But actually there are alternative concepts out there, or alternative exercises that would be quite useful, but they're very different, that we're not doing. And that's, for example, we're not trying to find the equilibrium exchange rate. Why not? Because we don't think there is just one equilibrium exchange rate is one reason. Since there's policies, and since policies can be good or bad, that means there's different policies, good or bad, that can be sustained over time and show up in different current accounts and real exchange rates. So if we talk about equilibrium, we're not really being clear about what we're talking about. What we'd like to think would be that a shortcut would be, well, if a country has a bad policy, that'll prove to be unsustainable. That can't be part of an equilibrium. But we know and then we can all think of examples where that happens. But we also know that policies can be slightly off, or just simply bad for welfare, bad for private saving decisions or something else, and be sustained for a very long time. So the equilibrium concept, we don't think it's not the norm it's not the kind of norm we're after. We're also not trying to, equilibrium also sort of implies we'd be looking at deviations from where the exchange rate will settle when temporary influences have gone away. But we don't want to do that, because that would be, for our exercise, that would be assuming that temporary influences on the current account and real exchange rates are always bad, that those are not natural. Those are things that we want to put into a gap and call part of under or overvaluation. So we're not doing that. Finally, we have a separate exercise that I won't talk about today, but it's focused on sustainability. We see that as another question, another way of looking at current accounts and exchange rates. It's somewhat different from our normative. So that's what we're trying to do. How do we do it? Okay, well, we start from models. We start in particular from our new EBA model, but the teams at the IMF look at other models and information as well. EBA is our tool to estimate the kind of current account and exchange rate gaps that I was just describing by our standard. It's a regression-based approach, so that's common. That's been around for a long time. It uses regressions to figure out how country fundamentals should affect these things. But it also has a normative second stage, because again, since we admit that policies have an effect on current accounts and real exchange rates, we have to come in and say, well, are policies appropriate or not? So it's more than a regression. It also involves judgments on individual policies and bringing those in. The model allows every country's position to be affected simultaneously by all other countries. And of course, that's the way it has to be, because my current account deficit is someone else's current account surplus. My under or overvaluation is someone else's also. So every country, no country has complete control over its current account or real exchange rate. It's all an interplay of what they're doing and what other countries are doing. Our model tries to take account of that. It has a way of doing it, and it even estimates then when a country has a current account gap, say, how much of that is coming from its own behavior and how much is a spillover effect of some other country's behavior. And related to that, the model yields gaps that are consistent across countries. So where are the numbers? Still one or two more slides. Okay. I won't go into the regressions, but I just want to tell you what the model takes account of. We're trying to take account of basically anything that could influence saving or investment. Appropriately or inappropriately, those would affect the current account and the real exchange rate as well. So we're trying as hard as we can to figure out where current accounts, well, first of all, to understand them, figure out where they should be, and then basically explain as much as we can. We do it in several categories. We have fundamental variables, they're sort of the traditional ones. We have some new, what we're calling other structural variables, risk environment related to institutions, countries' level of oil wealth, financial factors. We have global capital market conditions are taken account of, and of course those are not stable over time, and countries react to those in different ways. Capital flows towards riskier countries or away from riskier countries at certain times. We try to take account of a country's reserve currency status, which usually lets it finance a weaker current account balance than otherwise it could. And we take account of temporary influences. David mentioned that already. Finally, in policies, what we're up to now, we can't cover every policy that might be relevant, but what we're up to now is the fiscal policy. An interesting one, public health expenditure, which we found seems to affect private saving incentives, and that shows up in the current account in a pretty big way. Monetary policy, which we didn't have in last year's model. Capital controls, foreign exchange market intervention, which actually should be kind of mentioned together because they seem to interact and be important together. And then we were trying very hard to get a measure of financial policy failure or financial excesses that are allowed by financial policies or regulators. And what we've got is a crude proxy that's basically a credit excess measure. And that's what we've got in the model. Anyone who wants more detail can find it online, the data sets, the programs, everything. But I want to emphasize that the model treats every country, we've got 50 actually in this exercise, uniformly. So every country enters the regression the same way without any particular judgment from us, although we do have some ways in the model in which countries can be affected in different ways by the same shocks. Those are according to measured characteristics. All right. So I've pretty much said how the EBA model works. What we're doing then is we've run the regression, we find the fitted values, then we do the key part of bringing in the normative aspect and the policies. We don't look at where actual policies are. We substitute in where we think policies should be. That, together with the cyclical factors and the structural factors, gives us a current account norm or a real exchange rate norm. And then we compare those to the current accounts and real exchange rates we actually see. That gives us a gap between what we think should happen and what we're observing. That gap, though, has two parts. One is the identified policy gaps contribution. That's our big our innovation over what we've done in the past. And then, unfortunately, we still, in the gap, have an unidentified residual that we don't want to presume either guilty or innocent. It needs to be interpreted. So that's something that happens in the final stage. Weighing of models and evidence. This is the border between our EBA results and other models and the ESR assessments that David was talking about. So some models work better for some countries. Sometimes we know why. The fit is better. There's other information that can't fit inside our model. All that comes together in an assessment process, a simultaneously done process at the IMF to make these judgments, the final judgments. And importantly, those judgments are constrained. People can't just say, well, I think this or I think that. The judgments have to all add up. At the end of the day, the current account excesses or current account shortfalls have to match and offset each other, and the same for the real exchange rate gaps. Okay. David, did you want to pick up at this point? Okay. So now we get to see how things turn out.
Okay, thank you, Stephen. This was the last rotation between the two of us. So. Yeah, applying the models. As you know, we had this similar report last year, and so what we tried to look at here was how our estimated imbalances, those, which is the difference between the measured as just the actual numbers versus the calculated norms, how those imbalances changed from 2012 over to 2013. In 2012, those are the blue, I guess, circles. The 2013 estimates are the pink square blocks. And here on this chart, we have pulled together both some of the larger economies, but also some groupings. We have these, obviously, for each of the individual countries, but we couldn't fit everything on the chart so easily. And what we have seen is that certainly for most of the countries, most of the groupings, we have seen somewhat of a narrowing of the imbalances. They're getting closer towards the zero. This is true for China on the surplus side. On the deficit side, also the US has moved slightly closer. But what we have also seen is that there are a couple of countries that, particularly in Japan, you see there's a very large range that we put on this. I mean, I should say, reflecting, we acknowledge the uncertainty of the estimates when we calculate these things. So we have tried to put in a range where we felt captured the degree of uncertainty for where we were. In Japan, there's quite a large range there, and that is quite deliberate. We were doing this assessment just at the time of the announcements of the Abeconomics, and in particular, the loosening of the monetary stance. We had seen a very large depreciation, over 20%, from the third quarter of 2012 through until the first quarter of 2013. There is a lot of uncertainty in terms of the timing of the effect of a lot of the measures and their implementation. And so certainly, given the degree of the uncertainty around the macro policy framework and the timing of some of the measures, we thought it was appropriate to put in a somewhat larger range than we would normally do. A couple of other points to note on this one. The US imbalance, we are showing a slight narrowing in 2012, and we would also expect to see this narrow further in 2013, essentially driven by both a combination of the lower oil prices, but also the more coming on stream of domestic energy production. I mean, the euro area here, we are presenting this for the euro area as a whole. And certainly there, the aggregate external position appears to be broadly in line with the medium-term fundamentals and the desired policies. But it does mask, as we'll see later, quite wide divergences across the economies. Now, this was the chart done for the current account balances. We have a similar assessments done for the real exchange rates. And again, a very similar pattern, so I won't spend much time on this one. Now, essentially the final chart in the assessment component is to really break through and try to pull out the information from the EBA model and our other assessments to try to work out what is actually driving these gaps. And here we have done this for each of the countries in the sample, the 29 covered by the ESR. And the diamonds essentially are the midpoints, the total of the gaps that we are identifying. And then we try to break out the individual components. And one of the innovations that we did this year was to try to break out the fiscal policy component into a domestic fiscal policy, but also then the impact of the global fiscal policy stance and how that filtered across into each of the economies. I know there's a lot of information on this chart, and hopefully you'll get a chance to study it in depth later. But I think certainly, here, one of the key messages we took from this is that, there are clearly cases where the policy gaps were known. I mean, they obviously get reflected in our Article 4 consultations and the policy discussions around those. But there are also a few cases where, we do still have some questions as to what exactly is driving, the imbalances. These show up as what we call this unidentified policies and other, to reflect some of the aspects that maybe are not captured in the standard model we use for the EBA. And in the report itself, we do have a separate box that tries to walk through those to try to give a little bit more background on where we see these divergences coming through. One of the other components that I should flag from this global fiscal component, I mean, obviously given the current conjuncture where there's a lot of concern on the pace of global growth and the need perhaps for some stimulus to try to support growth, what we are seeing is that is contributing throughout to this policy gap. But certainly, this is a component that we would not expect to see change in the short term. I mean, this isn't, I'm sorry, please don't take from this that we are recommending the immediate fiscal consolidation throughout the globe. No, that's not the recommendation. I mean, obviously this has to be timed consistent with the pace of global recovery. In terms of trying to pull together a few conclusions, I mean, what we have seen, obviously, for the last year or so, is that the external sector positions and policies have really been shaped by the policy responses to the growth slowdown in the global economy. We've seen this through the impact on growth, the fiscal positions. We've seen this through the capital flow volatility reflecting in part UMP and other things. We have, though, seen some narrowing in the global imbalances, and they're now down to around 0.75% of global GDP, which is fairly significantly lower than 2006-07 when we first started. The global imbalances phrase really hit the policy agenda. Part of this narrowing is, of course, cyclical factors, but there have also been some policy adjustments which have helped to contribute closing the gaps. Then a couple of remarks at the end. Yes, we have seen the capital flow volatility. It has been on the agenda, and I think we're now in a position to say that that volatility is likely to continue. And given that we presented this report back in, I guess, May, June time originally, that unfortunately has come true. That volatility is coming through. And certainly as we move forward, some notion of policy coordination could maybe help towards achieving a much healthier version of rebalancing. But I think we should end our presentation here. Thank you.
Well, as with the best international officials, there's a lot of not only thought, but dangerous stuff hidden in the language of calm. I'd like to thank Stephen and David for being forthright, not only with the dangerous stuff, but also with the methodology. And I really, for this audience in this house where we've been debating these issues, as many of you know, for a long time, we very much appreciate the fund continuing to engage and think about what's an equilibrium exchange rate, what's not, what's an appropriate current account balance, what's not, and it's not simple. And it's in that spirit I would like to call upon my colleague Joe Gagnon to give some comments from both a methodological point of view and where the conclusions might be. That also is dangerous stuff, but he's no longer an official. Joe, as many of you know, had a very distinguished career at the Federal Reserve Board, ending as associate director, I guess, in both the Division of International Finance and finally Division of Monetary Affairs, and was one of the key advisors to the Federal Open Market Committee on the creation of QE1. We've been very proud to have him with us full-time the last few years. You have available to you today, also on the website, his recent working paper on the elephant in the room, where he has done some very interesting work on the impact of foreign exchange intervention by officials, by governments on their exchange rate, but more broadly has been thinking about these issues of global imbalances for some time. And so, Joe, if we could have your comments, please.
I'd like to thank also David and Stephen for a very good presentation of what the external sector report is doing, so I won't have to repeat that for you. I'm going to focus my remarks on what I hope are constructive suggestions, areas for improvements. It's a nature of discussion to sort of be critical. I want to start from the outset to make it clear that in terms of the framework, the concept, what the IMF is doing here, I'm a complete supporter. I think it's exactly the right way to go, to consider all the globe together simultaneously, to think about policies, how they affect imbalances and how to make them better. So I don't want to lose sight of the fact that I think this is really a huge improvement and the right way to go. I'm going to limit my comments to sort of more areas within the same framework of execution that I think could be improved. Right. So my biggest concern is that I'm afraid that this is the old slide, excuse me. The bottom line is that because we really can't model current account imbalances as well as we'd like, and I have some suggestions for improving that, but no one really can explain all that's going on. So you're forced to have some judgment. You've got to have some judgment about what norms should be for countries. And I think my concern is that in the course of applying the judgment, the current account norms are too often set sort of too close to where countries actually are, and not rigorously thinking about where they maybe should be. I'll come back to that in a minute. I think, in particular, I think that the effective reserve accumulation is I believe, underestimated. The norms for reserve accumulation, I think, may be set too high. The fiscal policy is, of course, an important element of all this, and I think they're broadly okay, although there is a bit of a asymmetry in how fiscal policy is dealt with between deficit and surplus countries. But some broad conclusions that you saw that I do agree with. I think the report says that China needs a more flexible exchange rate, and there has been some improvement in 2012. I think the future looks a bit more worrisome. Germany needs more inflation in order to help its euro area partners rebalance. Non-renewable resource exporters should have moderate surpluses to save for future generations. Euro area and Japan should have small surpluses because they're rich countries that are growing slowly. Most emerging markets and developing economies should have small deficits as part of sort of funding long-run development. These all seem right to me. And one of the interesting findings, which Steve mentioned briefly at the end, is in surplus countries, an important policy for surplus countries seems to be public health expenditures. This is also true in work I've done, and I believe other people, that even after you control for the fiscal deficit, if you switch spending towards social safety net type programs, and particularly public health, you get a very big effect on the current account. Even controlling for the deficit, it seems that each dollar spent on public health reduces the current account surplus by 50 cents to $1, which is a really big effect. But it seems robust. It seems important for China. I think it may extend to other areas of social policy. I haven't got the data to do that myself, but I think this is an area for further work. I think what the report talks about, a lot of surplus countries should be boosting domestic demand, and it doesn't talk about how. I know there is some other work at the IMF and the OECD on that, but I think that work still needs fleshing out. It's certainly an area for further work. Some conclusions that I have problems with are the following, and I think these are sort of examples of where I think that the judgment has been used to make recommendations or norms that seem sort of conveniently slanted towards where countries actually are. So rather, we tend to say where a country is where it should be. I worry about that. This is particularly true in Asia. But also, strangely, Brazil seems an odd country that you should recommend to have a surplus. Switzerland and Singapore are recommended to have very large surpluses, which measurement error has a little bit to do with it, but I don't think can explain all. On the other hand, Canada, the United Kingdom, and the United States are the norm is to have a small deficit. I'm not sure why we should want rich countries like that to have deficits. I mean, there is the reserve currency role, but I'm not sure that's something we should think is necessarily a good thing. So turning to some of the underlying issues, I think the norms for reserves, in my view, are too high, and there's two reasons. One is the analysis that underpins this is based on an IMF research from 2 years ago, in which it's basically assumed that what countries do on average is correct, and we just look at differences across countries. If countries have more or less reserves than would be expected given their conditions relative to other countries. But this sort of doesn't allow for the fact that maybe countries on average have too many reserves. The analysis also doesn't take account of the fact that many countries are borrowing more in their own currency and less in foreign currency, and so the relating reserves to foreign debt isn't necessarily the right thing when that foreign debt's not in a foreign currency. These reserve accumulations, or net official flows, have jumped way up and exceed about $1 trillion a year now for almost a decade, which is about the same order of magnitude nearly as the imbalances themselves. So it really suggests that it's something that could have the potential to explain a lot more than it does in the report. So to just give you a little background on that, we know that current account has to be financed. It has to be financed either from official flows or from private flows. And so the equation here, current account CA equals net official flows, NOF, plus net private flows in PF. These interact, and interest rates and exchange rates move and adjust to make sure this equation always holds. But it must be the case that an increase in official flows, reserve accumulation, must either be associated with an increase in the current account or a decrease in net private flows, or some of both of equal magnitude. Now, which it is depends a lot on the efficiency of markets, and I think the IMF is right to talk about capital controls as being an important factor. I do have some concerns because I really don't know of any measure of capital controls that does a good job, but we have to work with what we have. But even in a perfectly open financial market, it's possible that financial markets just aren't efficient, and so we should allow for the fact that perhaps financial markets don't equalize rates of return. If they did, you would see that net official flows would have no effect. When they go up, private flows would just go down and offset it. But to the extent that markets are closed, net private flows can't move, and then it must all show up in the current account. So how much of net official flow shows up in the current account is really restricted to a range of 0 to 1, 0 if there's no arbitrage, 0 if there's full arbitrage, and 1 if there's no arbitrage. So in the underlying work here, the IMF has estimated that the effective reserve accumulation, net official flows, each dollar of reserve accumulation affects the current account by anywhere from 0 cents to 40 cents. And that depends on the capital controls the country has. The more controls, the bigger the effect. In my work, I get a much higher effect. I get anywhere, and that's the paper that you have were provided, anywhere from 60 cents to $1, and I haven't been able to get capital controls to work in this range, but I'm still working on that for the future. Now, I raised some issues in my paper as to why we get different results. I don't have time to go into that now. There are some tricky statistical issues dealing with the fact that all these variables are moving together, and you can see the paper about that. I think the IMF, in the latest version of their work, still really hasn't addressed those issues that I raised. So I don't have a lot of time, but let me just show you some examples of countries just to get a flavor for what's going on. Here is China's current account balance in the bars, and the line in this graph is China's reserve accumulation, its net official flows. The dark red parts of those bar, the shaded parts of those bar, is what the IMF, implicit in this external balance assessment, estimates how much the reserve accumulation affects China's current account. So about 1/3 of China's current account could be attributed to reserve accumulation. But my work would say more like all of it is attributed to reserve accumulation. So to some extent, you have to be the judge. I would argue that private flows in China are very restricted. Private flows are the difference between the solid line and the bars. That's almost entirely foreign direct investment, which is negative for China. That's why the bars are lower than the line. And that's a pretty slow-moving, gradual process. Other types of capital are tightly restricted. They tend to fluctuate around 0 and are much smaller. I just don't think there's a possibility for private markets to undo what China's doing. If China let the renminbi float and didn't buy a lot of reserves, I suspect China would have a current account deficit, which would not be too surprising for a country in that position. What about a country that has open capital markets? Well, you might think there should be no relationship between reserve accumulation and current account in an open, efficient market. And we see here that for Norway, reserve accumulation, which is, again, the solid line, is very closely related to Norway's current account. Whereas the IMF says that's a coincidence. That's just a coincidence. Don't believe what you see. There's almost no effect of what Norway does on its current account. I know if Norway's government didn't buy a lot of foreign assets, I imagine some Norwegian private citizens would, but do you really think that they would fully offset what Norway's government's doing? That's what the EBA says, and I guess I question that. Now you might say, well, this is unusual, this is an oil exporter, oil exporters have surpluses, and Norway's government is buying these reserves because of its oil exports. But it's not the case that oil exporters always have surpluses. In fact, if we look at the biggest oil exporter in the world, Saudi Arabia, until about 10 years ago, it was running continual deficits, despite being the world's biggest oil exporter. And here's Saudi Arabia for you. The dashed line is Saudi Arabia's oil exports. Again, the bars are Saudi Arabia's current account balance. And the solid line is Saudi Arabia's reserve accumulation, or net official flows. What you see is that the current account balance is determined by the net official flows, not by the oil exports. So there's nothing special about oil exporters in this regard. It's what you do with the money that matters. Okay, so, to be fair, not every country is so clear, and this is why it's a difficult problem. As I mentioned, there's statistical issues involved. If we look at another important country that does reserve accumulation, has a lot of reserves, is Japan. Now for Japan, again, the solid line is reserve accumulation and the bars are Japan's current account. The correlation is clearly much less strong for Japan. And I think there's important issues. There's reasons to think that maybe correlation was overstated in the earlier examples, but I think there's reasons to believe it's understated in this example. What's going on is that private flows, which is again the difference between the line and the bars, are quite volatile, and sometimes the Japanese government steps in when the famous Mrs. Watanabe gets afraid of sending her money abroad. And this helps to hold up Japan's current account when it would otherwise fall. But again, that just shows sort of the difficulty in really nailing us down. Finally, my final slide. I think the report, discusses, and as we heard, there's been the success of a narrowing of imbalances from where they were, and the vertical line here in this graph shows where we are now and the imbalances of the two most important and largest imbalanced countries. And it's true that they have moved sideways in the past couple of years. But I fear they're set to widen, and this is the IMF's April forecast going forward for imbalances in these two countries. I think in the case of China, there are two offsetting factors. The forecast here is based on a constant real renminbi, but the government of China has been allowing a gradual appreciation of the renminbi, which I expect to continue. That would tend to hold down its growing surplus. But on the other hand, I think there's an offsetting thing to consider, which is that the IMF forecasts have typically been reluctant to forecast widening imbalances. They tend to be more on the optimistic side, where imbalances either stay constant or narrow over time. I think this inbuilt optimism, in my view, offsets. I think that the two roughly cancel in my mind. It seems to me China probably is on balance, even with a slightly appreciating renminbi, on set to start having a growing surplus, and I think we already see it in the latest data. In the US, I think we're likely to see an even bigger widening if we get growth. I think the reason we've been stalled out for the past couple of years is because growth has been well below where we forecast. But if we finally get a recovery, especially in the advanced economies, I think these imbalances are set to widen. And I think this is absolutely critical for the IMF and the global community to get ahead of this problem before it starts to occur. Thank you.